whether you want to preserve capital or you want to grow capital, depending on which end of the stick you are, the use of derivatives for me, with regards to that particular, with regards to your capital itself, for now, I would not go speculative. I would just want to use it to preserve value. That is the first thing. The issue around capital cost that you're talking about, it's mostly related to the people who provide, the financial institutions that will provide those, the structure. In providing the structure, what will be the prudential requirements? Because all those things will fund the cost to the corporate. So there is a market cost for any instrument you want to go into. Before I then talked about the credit risk itself. He raised one fundamental question around transparency of information. Right now, it pays the financial institution for this asymmetry to continue, for this thing to continue to sit. Why? Because we've talked about debt of knowledge. We've talked about you want a perfect market where that information that's going to either raise the value, either be this, that will affect the liability. So for us, it will be a liability. So something happens in our industry and there's a curve. What happens immediately? That incident is priced into the curve. And the true and fair value of that capital or the financial status of that institution immediately. So for us, I would not go speculative. I would rather go on the other side.
Hello? Okay. I think in getting started, we need to get our ducks in a row. So in other markets, the speculators, yes, but I think there was a use case first, right? And I think it's the use case we need to sort out first. And in sorting out the use case, from an investor perspective, some investor groups are closer to using derivatives than others. So if you ask me, I would say the insurance companies, your typical asset managers, are closer to using derivatives than the pension funds. So the pension funds might be the largest pool of assets. But the truth of the matter is we need to get the industry or get the asset class going. So maybe we shouldn't wait. We can bring those on stream first and also use them as test cases. So there are insurance companies today who do repos, for example, right? There are some who wouldn't call it repos. They would probably call it, sell and buy back or what have you, right? But we can then formalize that market. Okay, we can formalize the interest rate market. And then as other regulators see the use case, they can then come on stream. Because if we limit the conversation to the use in corporates or the use in pension funds, right, we're also disenfranchising other market participants as well. I'm sure the FMDQ has engaged SEC and other regulators, but I think that, given that they are closer, I think we can actually strike and move forward.
Participant in the Nigerian market, we are not allowed to speculate. So a derivative by its definition, you're trading the value of the underlying assets that the contract is drawn up, and then you're trading the volatility. So what I'm going to say is that I'm going to trade my view, right? So I have a view, interest rates are going to go up. I need to look for somebody that has an opposite view. So I wouldn't say speculation, but I would say I'm just trading the view and then the assets, the underlying assets. I hope that answers your question.
Okay, Paul. So Paul will answer, then Paul will answer the first question as well about the derivative blowout.
So I wonder if I could try and answer both questions here. With respect to investors' use of derivatives. I'm sure we all appreciate that there are different levels of so-called sophistication when it comes to applying and understanding derivatives. Again, if I just go back many years when I was at the Life Exchange, we went out and engaged with the fund managers, the corporate treasurers, the brokers, the dealers, the market makers, because they were the people that were in the front line, so to speak, of the exchange, and they were going to be trading with these products. Of course, in many cases, their clients would be similar funds, institutions, but we didn't, as an exchange, promote the derivatives from a speculative point of view to retail customers. That was never a part of the mission of the exchange. Derivatives, as we know, were originally created 8,000 years ago to manage market risk, and they have been used throughout that time. Yes, in recent generations, people have started to get perhaps a little bit too clever and in some cases overcomplicate the structure of these derivatives. In the earlier session this morning, the focus was on promoting the advantages of central counterparties. What centrally cleared derivatives do is that they instill discipline. They create transparency. And during the financial crisis, it has to be said that there were one or two institutions that got into difficulties, so-called clearing members, but no other participant on a centralized market lost a single penny because of the discipline that was instilled by the central counterparty on the clearing members through this process of initial margin and variation margin. Now, speculators are a fundamental part of the derivatives markets. They create, in many cases, the bridge between the hedges. If you had a market just of hedges, you're often going to find, from experience, that the price that one wants to buy and the one that wants to sell, they just can't meet a happy medium. So the speculators, the risk takers, if we use a different expression, are there to create that opportunity for hedgers in times when they can't lay the risk off to another hedger. They can do it to speculators. Now, speculators can come in many forms. You can have speculators at institutional level. And of course, before the financial crisis, a lot of universal banks would have had their proprietary trading desks, their prop desks, where the banks gave them some capital to speculate on financial markets. People speculate not just on derivatives, they can speculate on bond prices, commodities, equities. It just so happens that derivatives have this so-called inbuilt leverage, which is very attractive if you are a speculator, because it means with sometimes a small amount of capital, you can get exposure to significant economic movements in the underlying. But again, by having a robust system in place where you've got the clearinghouse, clearing members, anybody that's trading on a derivatives exchange, their positions, if you're a speculator in particular, are going to be monitored throughout the day. And as I'm sure many of you appreciate, that there is this discipline that's instilled upon the market where you have to put up initial margin and variation margin. And if markets become particularly volatile, then you're going to find that you're going to be margined during the day as well. So I do fully appreciate that sometimes derivatives have a bit of a bad reputation from a speculative point of view, but these speculators do provide that liquidity. And, just one final point. Again, I do remember doing some presentations early on when I came to Nigeria, and again from my time in the UK many years ago, is that when people think of derivatives, they do sometimes think, well, speculators are going to run riot with the prices. They're going to force up the interest rates derivative or force down prices here and there, and the markets can become very chaotic. But of course, with our knowledge of derivatives, we understand that there are theoretical values to which the derivatives price or rate will be contained. And if it steps out of that line, then you're going to have another type of, in inverted commas, speculators coming in. And of course, that's the arbitrager. And what arbitrages do is that they, again, instill the discipline in the market to make sure that the speculators don't sort of run riot.
Okay, so just to add, I'll try and do this in less than a minute. If you remember, I think everybody here should remember that a decade ago or so, maybe a little less, we had the ban on commercial papers by the central bank. Commercial papers is a product. It's a very simple product. You borrow money, you give a promissory note. And yet, that product, as simple as it was abused. Every product is subject to abuse if the regulations are not done properly. But what then happened subsequently was once the abuse was noticed, there was a pause on the product, and then FMDQ came up a few years ago with a very clear guideline on if you want to do this is the process, this is the procedure, this is the regulation, and this is the transparency that will be involved. Now, based on that, we have not had any abuse subsequently. So what Nigeria has is an advantage in a look-back scenario. We have seen where the abuse can happen, so we can preemptively bring up the right regulation, the right transparency, the right oversight, and with a lot of everything going electronic, it makes it significantly easier. There will always, as long as you have human beings, there will be abuse. The issue is that, and as we've heard from a lot of the panelists, we need the regulators to be able to be up the curve and anticipate what will happen and preemptively regulate all those things, especially electronically. I don't think we're far away from that. I think it's something if we sat down seriously to execute with FMDA, the corporates, the regulators, I think we would make significant progress. I think our time is up totally. So just as a thank you for everybody on the panel, thank you for all your contributions, thanks for the questions. And as a summary, I think what I would like us to take away is that one, derivatives are not new. Derivatives are a product that can be quite complex, and which is why the discussions around derivatives are for a very specialized group of people who have been properly trained, properly educated, properly informed, and properly regulated. And once we have those ducks in a row, and I think FMDQ has done a fantastic job on that, I don't think there's anything else holding us back unless the market is not interested. And the market has told us that they are very, very interested. So, thank you, everybody.
Thank you very much, Zil. Please put your hands together for them. Thank you for the insights. Obviously, thought-provoking. Can we have all the panelists and moderators step forward for a group photograph again? And again, I would like to invite Mr. Onodele to join them for this. I don't think Mr. Ako is here. Is he? Right. We'll also be delivering some plaques. All right, Mr. Ako is not here, but we'd like to invite another board member, Ms. Daisy Ekine, to join us on stage for the photograph, please. I can. The first is to Zil. Yes. Right after this, we'll be breaking for lunch. Lunch is served on the 4th floor. So there are some hostesses in the foyer that will guide you to the lift. And then when you get on the 4th floor as well, there are some hostesses to guide you to where you should be. Mrs. Dosumu. David, you're next. Okay. The last would be Ishmael. And that's it. Thank you again to our panelists. So we will be breaking for lunch. Lunch is served, as I said, on the 4th floor, and there are some people at the back to direct you to on how to get there. We would continue with the next panel session right after lunch, and that will be on, if you like, the theme of today's conference, Nigeria, a compelling destination of capital. We'll be having contributions from the Central Bank, the National Pensions Commission, one of the corporates in Nigeria, the Debt Management Office, the SEC. They will all be adding their voice